Have you ever wondered how much of your hard-earned savings can disappear in taxes when you decide to sell your house or even cash out your unit trust investments? Ever heard of capital gains tax or CGT and felt a pang of anxiety, wondering how much it could affect you financially? Now, if the answer is yes, you're probably feeling a bit uneasy about it, and let me tell you, you're not alone. Capital gains tax can feel like a looming monster hiding in the dark corners of your financial planning. But don't worry, it doesn't have to be as scary as it seems. I'm Devon Iker, a certified financial planner specializing in helping individuals just like you make sense of complex financial terms and also identify the implications. Now, capital gains tax is a tax on the profit when you sell or dispose of something that's increased in value. And in a short while, I'm going to guide you exactly on how to analyze it using the iPad. Now, the tax itself can be significant. It can affect you when you are selling your home, when you are selling unit trusts, shares, or even certain types of business assets. Yes, you heard right. Even the place you call home isn't immune to this tax. Now, it may feel unfair, but understanding how it works could potentially save you thousands of rands. In this video, I'm going to break down capital gains tax in the simplest possible way. I'm going to give you practical examples, and you're going to walk away from here with a clear understanding of what it is, when it applies, and how you can manage it effectively. So let's get started. Now, I'm going to use a very, very basic example in this calculation because I want to make this process easy for you. And when you're doing the capital gains tax for yourself, you can then follow again using the example that I've created. Now, I'm going to use an asset here. Let's say you had purchased a property. So I'll write in a piece of property. And in my example, let's assume that you had purchased this property for R1 million. So you bought the property for R1 million and you sold this property at some time in the future, let's say 5 years down the line or so. And we're going to put a big gain here, right? So you sold this property for 1.5 million. So you notice you purchased it for R1 million, you sold it for 1.5 million. Now there's a difference here, right? That difference between the two is what is called a gain. And that gain in our example is 500,000. And this is what capital gains tax is all about, right? Capital gains tax is a tax on the gain. So it's not applicable to what you had purchased. It's applicable to the sort of profit that you made, right? Or the gain that you made on the sale of that asset. That doesn't apply to every single asset. And this is the reason why I'm using property here. But very interestingly, it can also apply to you if you have purchased unit trusts. So if you have any investments, a unit trust investment, then the same situation can transpire, can happen, right? Occur. So notice again, if it's a unit trust investment for R1 million, you eventually sold this and it was 1.5 million, you incurred a gain, and that gain of 500,000 is going to be taxable. Now I'm going to head over to a tax guide so that you can understand this and see how this is calculated, right? Always remember when you're working with the tax guide, you want to make sure that this is something that's recent. So I'm using the one that was applicable when I had shot this video. So you see the tax guide here is 2023 tax guide from SARS. Easy to get your hands onto this. You can download it for free off their website. And we're looking for the section that's applying to capital gains tax. So notice this is it here. And you'll see they've got a bit of information. I just want to guide you on certain things, right? That's applicable for you. So the first thing I want you to be aware of is you do have a 2 million rand exemption when it comes to a property, right? So if that property is your primary residence, so notice this, it must be a primary residence. If it's your primary residence, then 2 million rand is exempt. What it means, extremely easy. Let's go back to the example so that you can see what happened here. Let's say the property itself was your personal property. That's your family home. What SARS is now referring to as the primary residence. In this instance, you sold the property for 1.5 million, you made a gain of 500,000. Now, because that gain is below 2 million, SARS is saying it's fine. You exempt, meaning there's no capital gains tax on that, right? If it's a separate property, meaning let's just say you purchase it as an asset, it's an investment property. You have your own primary residence, and then you've got your own separate property. Now you don't have the 2 million exemption, in which case that gain is going to be something that's going to be taxed, right? Let's go look at some other things that are not part of capital gains tax. You can see here, most personal use assets are not part of capital gains tax. I'll give you a simple example. Let's take your motor vehicle. It's a personal use asset, so there's no capital gains tax, right? Could also apply to your furniture in your home. They're not items. Now, it's cut off to the next page, so I want to go through the other elements with you. Retirement benefits, meaning if you have a pension fund, provident fund, retirement annuity, there's no capital gains tax in terms of that, right? Payment in respect of long-term insurance policies. Easy example here is in terms of a life cover plan. So the touch wood, at the time that you close your eyes, that payment, there's no capital gains tax. You don't get capital gains tax, let's say, on an illness claim or disability claim. They also speak about an annual exclusion of 40,000. Again, remember, you want to check the tax guide so that you're understanding whether this has changed, right? But what they're saying is this 40,000 can be excluded. Let's go back again to the example. Notice again that 40,000 is applicable in terms of the gain. So if you have a look at the example that I've done for you here, 100,000 is the property itself. 1.5 million is what you sold it. You made a gain of 500,000. They're saying they can minus 40,000 from there, right? They can take away 40,000 off that gain. And let's go back. Then in terms of small businesses, if you're running your own small business, there's certain conditions to this, right? But you get a 1.8 million rand. And then there's also an annual exclusion on debt, meaning at that time that you close your eyes, you get now 300,000 for that tax year. Now I'm going to use an example here with the unit trust so that you get to understand how the capital gains tax applies on unit trust. Because if you're selling this all at one hit, then it can trigger a problem. So let's go back to use an example again. And I'm going to minus off the property in this case, right? I'm minusing off the property. And I'm going to say instead of a property, let's say you had unit trust. And I'm going to give you a tax secret here, right? So you have unit trust. You initially invested 1 million rand into the unit trust portfolio. And now you want to sell it. And the value of the unit trust is 1.5 million, which means you made a gain. Now, here's the secret. When you are doing this, you can actually structure this accordingly. So remember, your tax year runs from March of a particular year to Feb of the following year. It's running over that 12-month period. Now, let's say you are selling some of this inside. Well, if you're selling all of it inside this year, then you're going to have all 500,000 that's going to be applicable to CGT, right? The capital gains tax. If you're selling all, however, you can actually time this, right? You can time this, meaning you can sell here a portion. And again, if you get the planning done right, you can structure this according to the exemption. So you could sell a portion there, and then you sell another portion on this end, because that portion's falling into a new tax year. So if you are able to do this, you're sort of staggering this. And because you're staggering this, even though capital gains becomes applicable, but you sort of now are spreading this over a period. So let's use our example, right? If you are doing a portion, let's say 50%, that means only half is getting sold. So the gain applicable for that year is 250,000. And the gain applicable here is 250,000. So by doing that, because you spread over 2 tax years, you've now reduced this. Now, if it's a unit trust investment, you can obviously look at different ways in which you can structure this. Doesn't necessarily have to be over a specific period. There are tons of different ways, but now you have a technique that you can use in order to make the unit trust work better for you from a capital gains tax perspective. So I hope the video has been insightful. I promise you that this is going to be a very simple explanation of capital gains tax. So I want to see a comment from you. How easy is it for you to understand capital gains tax? Does it sort of make sense now? Are you feeling a bit more empowered with it? And can you use this information now to ensure that you are keeping the capital gains tax to an absolute minimum? Now, what happens, just before I go, one thing that pops into my mind is whatever the gain is, so whatever is taxable, remember that's going to be added to your salary at the end of that tax year. So that could push you up a tax bracket. So critically important for you to understand this, know how to use capital gains tax in a way that's going to work for you, right, to the best possible ability. Again, if you've not already done so, I encourage you to subscribe to the video and give me a thumbs up if you found the video helpful, because that helps to motivate me and inspires me to create these amazing videos for you. I will see you in the next video.